Hello, and you're very welcome to the latest and greatest episode of the Informed Decisions podcast. Thanks a million for joining. Um, yeah, great to be back. We had a couple of weeks in the Vendée region in France where we were basking in 25 to 35 degrees of sunshine, pool, ice cream, cycling out in beautiful bicycle trails. If you're into cycling and you like going off the roads a little bit, there's so many cycling routes, trails, cycle paths in that particular area of France. Any country lane you can cycle up it, unlike in Ireland where everything is gated off and boarded up. It's a fascinating place to be. The right to roam ultimately is alive and well over there. So anyway, we had a great holiday. I hope life is good for you, dear listener. We're back with a bang. I hope while I was away, you enjoyed the some of the episodes that we shared. It was great to be able to share a few episodes there that we had done in the past, and also a couple of interesting interviews. So yeah, hope life is good for you. So it was actually inspired by a conversation that I had in France with a fellow camper. I tend not to talk about work at all. I don't even tell people what I do. To be honest, unless I'm directly asked. I just like to be on holidays when I'm away. But yeah, one conversation with somebody who did know me was around defined benefit pensions. And so I said, right, as soon as I'm back, I'm going to talk about this because there are things that need to be cleared up. And in fairness, there are things that I routinely get asked about defined benefit pensions. And so I was like, yeah, okay, I think this needs to be revisited. Because people get their defined benefit pension statement and quite often it's like, don't really fully get the point they're making here around what it is or isn't. What should I do or shouldn't I do? So I wanted to share that. We're stripping away some of the jargon and shining a bit of a light, as it were, dear listener. Okay, so let's jump in. I suppose back to very basics just for a second, right? What is a defined benefit pension anyway, right? So it's a retirement scheme that pays you a guaranteed income for life. And that income is based on your salary, your years of service, the scheme, and a formula ultimately set by this scheme. Okay, your income and your pension income is not based on the ups and downs or value of a particular pot that you own. And we've spoken about this before, as I said, right? So check out our blog and just type in, you can use the search function on the blog page now to type in defined benefit, and that should bring up a couple of our past articles that will hopefully be helpful. Simply, a defined benefit pension it's a promise of future income. It's not an invested pot of money that you own and manage and look at and possibly fret about. These types of schemes, defined benefit pension schemes, were once common across Irish private companies, but most are now closed to new entrants and or to existing employees. They're a rarity now, ultimately. In the public sector, defined benefit remains a default for many, not totally across the board, but the likes of teachers, nurses, gardaí, civil servants, local authority staff, and some, as I said, lucky private sector employees still in legacy defined benefit schemes. But ultimately, there has been a massive shift from DB, defined benefit, to DC, defined contribution. So let's explore some of the things to maybe just keep an eye out for in understanding your DB scheme and a few steps, all right? And this will apply whether you're a current member of a scheme or if you were a member of a DB scheme and you've left that employment and you've left the DB scheme there, you haven't transferred it out of the DB scheme and into a PRB or a PRSA or some other buyout bond, etc. So whether you're active member or you're a deferred member. Okay. So the first thing I would say is get your hands on your pension statement. You may have one in your inbox. You may have one saved on your computer somewhere. You may have one stuck in a drawer somewhere. But just pull out that statement. And this statement should come to you at least once. Should come to you once a year. They're obliged to send you an update every year. So if you can't find one, maybe make a few phone calls and request it. Okay, ring your former employer who administers the scheme and contact them and ask for an updated statement. If you've moved address, make sure that they have the address. And if you move address in future, make sure they get the future address. So the statement, again, they're obliged to put a lot of information into this statement. And a lot of trustees do go to a lot of trouble to try and make it understandable, because it's in their interests. People aren't ringing them up saying, what's this mean and what's that mean? It's in their interest. So they do try and do that. But there's a lot of information that they have to convey, that they're obliged to convey. And it's not always the easiest thing to explain. So there's a couple of key types of information and nuggets that we need to look out for. So where to look? Ultimately, if you're in the public sector, log into your single public service pension scheme account. Contact your employer, your payroll department, your HR. And if you're in the private sector, as I said, your pay slip should note the provider, whether it's Irish Life or Mercer or Aon or Willis Towers, Watson, etc. Contact your employer and they'll tell you who administers the scheme. You can contact them for updated statements if needs be. Okay, if all else fails, contact HR ultimately. And what I will say around the statements piece is be sure to save the statement or statements in a secure location, whether that's physical location or an electronic storage system where your loved ones can also access them. And this makes it easier for you to access it and to remind yourself about your benefits in future at any time, but also for your loved ones to access it if you die or run away or whatever it might be, because they're potentially very, very valuable assets. So you want to make sure that people can track them down. Right. So that's the first thing. Get your hands on a statement. Then step 2 is when you're looking at the statement, there's really a couple of key numbers, right, that are important. The old 80-20 rule, right? 80% of the important stuff can be found in 20% of the statement, right? There's 2 things that I want to draw your attention to. One is your annual pension at retirement. This is the income you will or are due to receive every year for life at the point of retirement. And it can be described as annual pension at normal retirement age, NRA, or your accrued benefit to date. This section or this number ultimately intends to let you know what amount of retirement income, what annual yearly income have you banked in the defined benefit scheme already. So for example, it might say something like, and again, these numbers will vary, of course, but to use an example, 28,500 per annum payable from age 65. All right. That's 28,500 guaranteed income per year before tax for as long as you live once you retire. All right. Is that example of 28,500 per year a valuable asset to have, assuming you survive? I'm bloody sure it is. And keep listening for more. We'll dig into that and tell you exactly what it's actually worth, right? So that's an important figure, okay? So that figure can be shown as what you've accumulated already, and indeed it will usually always show what that income will be, assuming you continue employment and continue a member of the scheme, assuming they don't close it down or it's not shut down until 65. All right. So that there's the accrued benefit to date figure, and then there's the potential future income at NRA. So there's potentially 2 figures there. It's important to know what your current accumulated income is, because really that's all we have. That's what we've banked. As of today, if I left or was thrown out of here, what have I got in terms of defined benefit entitlement? And that's an important figure to note. And that's defined benefit entitlement at 65 or at my normal retirement age from the scheme, 60, 67, whatever it might be. Okay. That's a really important and a nice figure to know, right? Because it allows you to think forward. Okay, well, that plus my state pensions plus rental income or whatever other incomes I have or other pension pots I have, that's what we're heading for. That's ballpark where we're at, right? And that's, I believe, a good place to start. Another figure to keep an eye out for is any lump sum entitlements. Basically, all defined benefit schemes offer a tax-free lump sum on retirement. And this may be automatic or optional in exchange for part of your defined benefit annual income. And this is called commutation. All right. So, interestingly enough, worth knowing, it's slightly off the DB topic here, but an awful lot of people, let's say for argument's sake, in the public sector, will be doing AVCs. All right. Typically, people, well, I won't say typically, an awful lot of people who are doing AVCs are doing them because it's tax efficient in terms of on a yearly basis now, right? It's tax efficient thing to do with some income. I don't need the income, or I have spare cash here. Let's make some AVCs. Absolutely. Importantly, it's worth just following that through to, okay, let's assume we continue doing these AVCs. What's the potential AVC pot at the point of retirement? And will that be sufficient to generate my maximum tax-free lump sum from my employment? If so, it may, depending on what incomes you're looking at generating from the DB scheme, it may actually make sense to not keep funding indefinitely and blindly into AVCs, because potentially, and I've seen cases like this where depending on what income you and potentially you and a spouse may have in retirement, you may have a scenario where you're funding into AVCs, potentially not getting as much tax relief as you're going to pay in tax, right? By having massive AVC pots, because that's just going to add to further income. Again, I'm absolutely not knocking AVCs, a very, very smart thing to do. But my point is, follow that through. Okay, if we assume that we could keep doing X, and on the basis that my intention is to retire at Y, here's our other incomes, here's our tax rates at retirement based on what we know now. It's just a useful exercise to give you some clarity on what's the point of this? What am I doing this for? Okay, particularly if you're making sacrifices to make AVCs, we want to make sure that they are going to be beneficial, is all I'm saying. I'm not knocking AVCs. I'm not. Okay, so lump sums, going back to my point, automatic or optional, okay? And if you want to generate additional or maximize tax-free lump sums from pension schemes, how are they going to be generated? Are you going to commute some of your DB income or not? And an awful lot of people don't want to commute their DB income on the basis that they feel the DB income is a great thing to hold on to. So they don't want to sell some of that income in exchange for a lump sum at the point of retirement. Again, your tax-free lump sum is capped, etc. So there's calculations and things to consider in there. But again, all I'm saying here is the two figures to know from your statement. The 80-20 rule is, what is my income? What have I accrued already? And what will it be if I continue in this scheme until normal retirement age? And what are my lump sum entitlements potentially at normal retirement age? They're the figures. If you know that, you're in a really good place, right? Ultimately, if you have that in your head, it's very, very good to know. Third thing to get a sense of is your normal retirement age. Again, this is fairly straightforward and obvious to most people, but this is when your defined benefit pension typically begins. Usually 65 in older schemes and 67 to 68 in more recent public sector schemes post-2013 entrance potentially. And you may be able to retire earlier or draw benefits earlier. Your pension will be reduced if you do so. An actuarial calculation would typically be done there to calculate the reduction. So early retirement schemes, etc., all of those things, it factors in the reduction. And some public servants, so uniformed public servants such as Gardaí and Fire Service, can do the fast accrual options, which can be advantageous depending on circumstances. And then the fourth thing to keep an eye on it in your statement is your service years. So your pensionable service is the number of years you've contributed to the scheme, right? The member of the scheme. And this is vital as it's key part of the formula that calculates your pension ultimately, right? More years equals more income. So step one is get your hands on a statement. Step two, understand those key four numbers. And step three is to estimate and to recognize the true value of your defined benefit pension. This is what I believe we should do. Like a DB pension for quite a percentage of people, I won't put a number on that because I don't know, but the DB pension for quite a number of people will be worth more than their homes. Like, that's reality. Multiply, if you're looking at your statement and you're saying, okay, if I keep going to normal retirement age, what's that worth to me? What's my pension income? Say, going back to that earlier example of 28,500 per year. If we use that, if you multiply that annual income, even on a straight line basis, forgetting about increases, indexation, etc., 28,500 multiplied by 25 years, right? Which is, a general rule of thumb on how long people would hope to live after retirement, or expect or hope, depending on what way you look at it. 28,500 by 25 is 460,000. So a 28.5 grand DB income is worth the guts of $500,000 in that simple scenario. And it's an oversimplification, of course, but again, it just paints that picture. It's a valuable asset. And so that's a figure that I would encourage people to recognize on. Another way of looking at it, and probably more a practical way of looking at it. If you didn't have a defined benefit scheme, right? Let's say you're in a DC scheme where you were contributing a certain monthly amount, your employer is contributing a certain monthly amount, you're investing in certain funds that go up and down, and you hope that it's going to be worth X amount when you get to that 65 to stick with that normal retirement age number, right? If you were in a DC scheme and you wanted to buy an annuity that would generate 28,500 euros per year, and 28,500 is just a notional figure that I've picked out of nowhere, right? It's not tied to anything, just in case people thought it had some relevance. But if you wanted to buy an annuity that was going to give you 28,500 per year, and you're 65 now, you're going to need to have a pension pot of at least 550,000 for a single life annuity today. All right. So if you had 550,000 today and you go to an insurance company and say, I'm 65, here's 550K, how much of an annuity will you give me? They'll say in and around 28,500 euros. And we're now towards the end of July 2025. That's the rate. So in real world terms, your 28,500 euro DB statement is showing you that your DB is worth approximately 550,000 to you at the point of retirement. That's a significant value. It's certainly not to be sniffed at, and it really is something I think we need to recognize. All right, the very same as the state pension for those of us that are entitled to it. That's worth a lot of money also, right? So for households where both people for argument's sake will qualify for the contributory state pension, that is worth over 500,000. Okay, quite significantly so. It's worth a lot of money. We need to, I believe, recognize those things, appreciate those things, and understand them and protect them. All right. So DB scheme, quite often one of the questions, and the questions stem from when people are offered transfer value. So, whether the trustees or the employer are trying to get rid of people out of the DB scheme because it's a liability for the business, or whatever the case, or whether maybe there's redundancy on the table and this decision around the transfer value is on the table as well. It's something that's being considered for argument's sake. They're important decisions. And when it's 500,000, and quite often an awful lot more on the table, they're big decisions. Okay. So what makes a defined benefit pension so special? Well, my view is there are there's many factors, but a couple of the key things is inflation protection. Quite often, DB pension income will rise annually in line with CPI, or potentially capped at a certain rate, typically 2 to 4%. The income payable may not be, quite often not, index linked, and that is a negative, right? But it's something to be factored in. Spouse's pension. An awful lot of DB schemes will provide for the fact that the spouse or civil partner will receive half or sometimes 2/3 of your pension income if you die before them in retirement. So that's a nice little safety valve to mean that your pension benefit just doesn't totally disappear. That will pay some income, or pay income, a portion of the income, for as long as your spouse or partner are alive. Again, check your scheme rules, or ask HR for exact details on the spouse's benefits. There's no market risk, right? So while some of us love it and enjoy it and, benefit from the market volatility, others hate it and want nothing to do with it. And a defined benefit scheme can, providing the scheme remains systemically viable, can help avoid and remove that concern and potential anxiety for them entirely, which is a positive. And professional management, ultimately, you don't need to rebalance the funds or give any headspace about running out of money or running out of pension pot in retirement. That's all taken care of by the scheme. You don't have anything to do. You don't have to speak to anyone like me. You don't have to hire anyone like me or Informed Decisions to help you figure stuff out with regards to the scheme. It's all done by the trustees. So should you transfer out of your defined benefit? My starting point is always no, to be quite frank. My starting point is always no. There needs to be very, very clear and obvious advantage to transferring out. Start point is no. Convince me otherwise, basically, is where I would always start with, and I encourage you to do likewise. Some employers and schemes, in an effort to reduce liability, as I said, and future exposure, will offer you a transfer value. Now, this could be current or past members, to get rid of them, all right? Because it is a liability. Or indeed, they simply close the DB scheme, which happens some. Transfer value is known as TV. So again, we love our acronyms. So they've also created CETV, which is a cash equivalent transfer value. Taking a transfer value means that you're walking away from the guaranteed future income that the DB may have offered. You're taking responsibility for investing the cash equivalent value of your pension in a new scheme, the DB or DC scheme, I beg your pardon, at least until you retire and start drawing income, at which point you may continue investing it via an approved retirement fund and or hand it all over for an annuity. All right. So you're now it's on you ultimately. And you're potentially exposing yourself to poor advice. This is the thing. People taking TVs usually have to find someone to help them with this, and someone who has their best interest in mind, which can be difficult. I wanted to share a couple of real life DB decisions that we have worked on earlier this year. And for context, when someone comes to us for assistance on their exit strategy from employment, often a DB scheme will form part of their current or past employments. And when we do a route to branch analysis, and plan of their assets, it's often something that's in there, right? Because we're doing an analysis on their assets, their liabilities, and the generation of future income. The DB needs to be part of that analysis, right? So that has to be factored into the bigger picture, okay? And so there needs to be a deep analysis and consideration of the pros and cons, the ins and outs, and the nuances of that and how that fits into the big picture. So I wanted to share two cases. Obviously, totally anonymous here, very, very general in nature for specific reasons, of course, right? But case A, this person had accumulated many, many years' service with an employer and had accumulated six-figure defined benefit income. They were at the point where, they were financially independent, were leaving that employment, and were unsure if they would re-enter the workforce in the future. All right. And they were not at their NRA, I'll put it that way. They were offered a generous transfer value on the defined benefit scheme. The financial implications of retaining the DB or taking the TV were marginal, right? In terms of forecasting that out into the future using prudent assumptions, it was marginal, all right, in terms of the outcome, the long-term outcome of taking the transfer value or retaining the DB scheme. The decision to retain the DB, all right, and start drawing that DB income now was driven primarily by the psychological safety of having that guaranteed income for the rest of their lives, assuming the very solid position of the scheme continues. Like the numbers, the estate implications, the income differences, the taxation of future income, current and potential, were important to assess and to understand and consider. But the driver was the psychological safety and the removal of fear for that person. And I 100% back that decision for that client at that time and in that scenario. And I support them, and we support them as they continue to enjoy the next chapter. So that to me was a really interesting case to work on, because you can analyze the financial and the numbers up the wazoo, but really at the end of the day, the psychological, the non-financial has a huge bearing, and rightly so. And so that brings me to case B, where this person had again accumulated many years service in DB scheme with a former employer. So they were former members of a DB scheme. They were deferred members, so they'd retained their DB scheme over there. And they were getting annual updates on the future income that they would get from the scheme, and they were tracking that and they were monitoring that. And that was generally upward trending. And it was a large income if they remained in the DB until NRA. The TV, again, the transfer value was again generous for them. And we assessed the numbers, the timings, the estate planning, the future priorities, and the potential future outcomes of retaining versus transferring in the context of what's going on for the client at the moment and into the future. Again, all positive stuff, right? But that needs to be factored in. Incomes that they have now and will have in the future, other assets they have, other incomes that they will have now and into the future, and how that will all potentially impact the taxation of those things, the net impact. This person's priority, given other incomes that they have and other assets that they have and will have, was less so the income from the DB scheme and more so the maximization or the attempted maximization of the value and potential future value of the scheme to their beneficiaries. So the decision to take the transfer value here was a big decision which took several months to arrive at. But on the basis of their priorities and their objectives and probable outcomes, was absolutely the right decision for this client in this scenario and at this time. And indeed, since they've done that, they have experienced significant market movements thanks to your man across the water, right? But they have since and already achieved some very solid returns to make it that little bit sweeter for them. So they're already seeing some of the outcomes that they're gunning for, right? Again, Depends on your priorities. Should I take a DB scheme or transfer or not? Depends on lots and lots of things, not just the value that you're getting. Depends on you and what you're up to and what you're planning for the future and your own scenario. It really does. And it takes a lot of, to make an informed decision, to pardon the expression, it takes a lot of analysis and everything needs to be factored in my view. I want to remain positive, but I do want to talk about scams, right? And scams maybe is not always the right word, okay? But certainly in the UK, we saw there were historically lots of scams and fraud around DB transfers. But maybe misleading sale tactics are alive and well in Ireland. So not all will be scams. Many providers and firms out there advertise catchy slogans and offers. My concern and issue is that often leading people to make decisions maybe that turn out to be less than fantastic for them, in the future, and maybe boxes them into corners and reduces their flexibility and options. So keep an eye out and take your time around any decision around this, particularly where you see things like, get early access to your pension funds, by age 50 by doing X, Y, or Z, transfer your scheme over here and we'll get you a lump sum now and promise and guaranteed higher returns. Pressure to act fast, I suppose, ultimately. Whenever you see that, I always encourage caution. So please do use regulated and insured advice firms, and you can check any advice firm on the Central Bank of Ireland register. Okay, so that's again, obvious thing, but that's something to consider. That whole idea of transferring your scheme out, get access to it by 50, that's basically using the mechanism, and it's totally legitimate, of course, with transferring your scheme to a buyout bond or a personal retirement bond, a BOB or PRB, pardon the acronym. That's that idea of transferring it to one of those schemes, and those schemes can be accessed by 50. That's all that is. But that may or may not be the right thing to do. It may give you the lump sum that you're looking for right now, but it may also reduce your flexibility in terms of drawdown and scheme flexibility in future. So that's something to consider. All right. Do your research and make sure you know what is the alternative to doing this. If I didn't do this, what are my other options? Okay. I suppose that's a good question to ask. In summary, I hope after listening or watching or reading this, you'll be able to say, if you do have a DB scheme, I have a defined benefit pension scheme that will pay me X amount per year from age Y. And even if I left or was booted out of the company today, that's worth about Z in today's money. If that's the case, well done. You're in a fortunate position and mission accomplished here from me. If you're still unsure, as I said, contact HR, speak to the trustees, speak to the people who are providing the pension, and maybe ask those questions. How much, if I left employment, no plans to, but if I left employment today, what will this give me per month? If I stayed until my retirement age, what will this give me per month? And then you can do the other calculation yourself. And then watch how impressed they'll be. But again, speak to a financial advice firm, but please make sure they're insured, regulated, and decent at what they do. There are firms out there who specialize in public sector pension planning. That is not us. And there are firms that specialize in private sector and business owner planning. That's us. So maybe pick your poison. That's a terrible term. Apologies. But you know what I mean. Ultimately, our pensions are one of the most valuable financial assets we'll ever own. That's the reality. Yeah, boring, but not as sexy as property or other stuff. Maybe not, but they are valuable. And so I encourage that we understand them, that we appreciate them, and that we look after them. So I hope this helps. And sorry if I've rattled on. Maybe, the fact that I've been away, I had lots of built up verbosity available to me, and to which you're paying the price. So thank you for listening. I hope it was helpful. Keep the faith, and as always, you're a legend.